Let's talk about the credit outlook with regard to what Kathleen's been talking about here. You've got this outlook for the second half, and the document is using a Warren Buffett famous quote, of course, when the tide goes out.
That's right.
You find out who's been swimming naked.
Yeah, exactly. This has been a very, very interesting past 6 months for the Asian dollar markets. Plenty has been changing. The valuation argument, which was at its tights at the beginning of the year, now we are close to the wides of the past 4 or 5 years. So the valuation argument definitely has improved for the Asian dollar market in general. But at the same time, there are plenty of risks on the horizon. Number of them have been talked about. For example, the rising yields for US Treasuries, what the Bank of Japan does, the trade war scenario. At the same time, what's happening in China has also been leading to a lot of volatility in our markets over the past 4 or 5 months. So we think that now is the time to differentiate. Now is the time to differentiate between credits, because valuation argument has become stronger, but that does not mean that you get involved with anything and everything. So you differentiate, get involved with the kind of names where refinancing issues are lower, liquidity concerns are lower, and essentially that's what we are trying to say here when we are saying that the tide is going out.
There are a lot of defaults taking place at the moment in China. Does that worry you in a macro sense?
It is worrying, yet a healthy sign. At the same time, what has happened in the past 3-4 days, I think the concerns around increasing defaults, they should start to go down a bit. I would not say that defaults are not going to happen, but in terms of the kind of fiscal and monetary package or stimulus that has been announced in the past 3-4 days, I think that's going to make some difference to the accessibility to funds from the small and mid-cap corporates. To be honest, we were not expecting the easing to be coming up so quickly, although our economists have been calling for a broad-based easing in second half as compared to what we saw in the first half. So to me, it has come sooner than expected, but yeah, that's a good sign from a macro development point of view.
And just the perceived role of the yuan as an anchor for other emerging market currencies and assets at the moment, are you expecting that to be more destabilizing?
It is going to be a concern going forward if the pace of this depreciation is unabated. So if the pace continues unabated and we reach, say, 7 or more than 7 in a short period of time, I think the rest of the EM currencies are going to be coming under stress. And that's the bigger worry, because that has implications not only for those sovereigns, but also for the corporates which are issuing dollar debt from those sovereigns. So the risk is that it spreads to the other EM markets. We are already seeing what's happening in LATAM and CEMEA to some extent in terms of pressure on currencies. Asian countries, to a large extent, have been managing their currency volatility reasonably well so far. But this is a key factor to look out for at this point of time.
Anjesh, I want to throw up this quick chart from our GTV library, which goes back to one of the points you made earlier about this synchronized rise in global bond yields we saw just a couple of days ago, and largely on pure speculation as to whether the Bank of Japan is going to tinker with its policy when it meets next week. This is looking at the reaction in Japanese 10-year benchmark yields, and we saw that, of course, across treasuries, across the Aussie 10-year, even in Chinese bond yields as well. How much of this is kind of market participants creating a bit of activity during what is seasonally, a low liquidity, pretty quiet time of year? Or do you expect this to be a theme going forward as well, particularly as we do expect the BOJ not to do anything drastic, but maybe to kind of tweak things around the edges of their yield curve control, I should say, policy?
Yeah, well, if you look at the official stance, does not look like anything has changed. And we are going to have further clarity on that next week when Bank of Japan meets. That being said, the local participants or the traders around the world, I think they are going to price in a certain probability, which is not tiny. It is a meaningful probability that something is going to change. Maybe not in the next meeting, but over the next 6 to 8 months. And people are accordingly going to start pricing in the actions. What that will mean are two key things. One, in terms of the impact on US Treasuries, impact on the German bonds. That's going to drive the benchmark pricing for the global credit markets. And two, quite importantly, the behavior of the local Japanese corporates and retail. How is their behavior going to move from investing in the foreign markets and taking their money back into the domestic markets? Is that going to happen in any meaningful size? That's going to be another issue as well.